Can you believe a single exchange-traded fund could surge to a staggering 70 billion US dollars in assets in under 1 year? Some scoffed and said it was impossible. Others declared it was too risky. Yet BlackRock's iShares Bitcoin ETF did exactly that, shattering growth records in the 32-year history of exchange-traded funds. Welcome to this deep dive into the meteoric rise of this groundbreaking crypto product and how its explosive growth is rattling conventional wisdom across the financial industry. Today we are going to dissect the astonishing story behind BlackRock's iShares Bitcoin ETF and uncover how this seemingly overnight success could forever alter the way advisors, institutions, and everyday investors think about digital assets. We will explore the momentum that propelled it to tens of billions of US dollars within 341 days, why financial advisors are suddenly championing it, and how this milestone hints at seismic shifts in the world of portfolio construction. And of course, we will also wade into the regulatory and psychological factors that either bolster or bash crypto adoption, as well as examine how this fund paved a tantalizing new route for prudent investors who once shunned anything labeled cryptocurrency. In this episode, we will grapple with three vital questions. First, what gave BlackRock's iShares Bitcoin ETF such unstoppable momentum that it dwarfed previous ETF launches? Second, why are financial advisors, historically seen as the most conservative of gatekeepers, embracing crypto-based ETFs in their clients' portfolios? Third, what does the future hold for institutional and retail investors alike, now that the foundation of trust around a massive financial powerhouse like BlackRock has been placed under the crypto spotlight? We are about to unravel these developments from every angle, so buckle up. BlackRock, the New York headquartered financial behemoth, is no stranger to commanding waves in the investment world. Its very name evokes images of institutional gravitas, caution, and formidable capital in motion. Yet few could have predicted that the brand's venture into spot Bitcoin ETFs, once regarded as a peculiar fascination for tech-savvy speculators, would turn into such a pivotal development. The iShares Bitcoin ETF, commonly referred to by its ticker symbol IBIT, reached 70 billion US dollars in assets under management in less than 1 year, shattering earlier growth milestones in the exchange-traded fund arena. Before this remarkable leap, the fastest any ETF had reached that kind of figure was well over a year, or in some cases multiple years. But IBIT's head-spinning ascension took place in just 341 days. That, folks, is akin to a rocket launching straight out of low Earth orbit and whizzing toward the moon. What happened to trigger such a dramatic shift? How could a product that invests in one of the most volatile assets on the planet, Bitcoin, snowball with such velocity? The first big element is brand trust. BlackRock has been a bulwark of traditional finance for decades, commanding mind-boggling sums of institutional money. If you are a cautious family office or a conventional financial advisor in a large wirehouse, you usually do not just jump on to the latest fancy crypto scheme for your clients. The risk concerns, not to mention compliance headaches, can be astronomical. But when BlackRock says, "We are behind this product," it is a different matter entirely. Suddenly, it is no longer some freewheeling, untested startup claiming to wrestle in the big leagues of Bitcoin. It is arguably the largest asset manager on the globe, with a household name that spells stability, or at least the closest thing to stability one can get in the volatile universe of digital assets. The second big element is the demand from advisors and their clients. For years, many professional advisors fielded questions from curious clients who wanted to know whether Bitcoin was a legitimate investment or just the flimsiest of bubbles waiting to pop. Some advisors responded by leaning on old lines about lacking intrinsic value or excessive volatility, and that discouraged a large portion of potential crypto dabblers. Other advisors quietly began sifting through official guidance, waiting for the day they could propose an investment vehicle that bridged the intangible nature of blockchain with the safer hallmarks of conventional finance. That day arrived with IBIT. Indeed, according to filings known as 13-F, a significant chunk of the fund's asset holders, about 20%, are now investment advisors. These are folks who might ordinarily steer clear of brash bets, especially for their more conservative clients. Yet, they have steadily embraced IBIT, signifying deeper trust in both regulation and technology. Some projections even suggest that within the next year, advisors might hold as much as 35 to 40% of the entire ETF. If that indeed comes true, it will be a watershed moment, the kind that cements crypto's place not just on the fringes, but squarely in the middle of mainstream finance. But let us not forget the regulatory tailwinds. By many accounts, the Trump administration took steps that eased regulations around digital assets, allowing the industry to operate more openly and fueling unprecedented investor optimism. This environment, coupled with the potent brand power of Blackrock, created a perfect storm for spurring investor confidence. And even though Bitcoin's price can gyrate quite dramatically, at times the market's bullish fervor soared. In fact, analysts began noting that Bitcoin's price was inching near 105,000 US dollars, a breathtaking rally that dwarfed the performance of many other risk-on assets. Regardless of whether you are a cynic or believer, it is hard to dismiss such vapor trail growth. Does this mean everyone should recklessly dump their retirement funds into crypto? Absolutely not. This scenario is more complex than a simple yes or no. Yet the iShares Bitcoin ETF phenomenon speaks volumes about how robust the appetite for digital assets has become, and how even risk-averse segments of the market are stepping into territory that had, until recently, seemed too exotic or unregulated to be worth the trouble. Financial advisors, many of whom used to dismiss Bitcoin, are now reading up on blockchain, compliance issues, cold storage solutions, and more, all to ensure that they can guide clients effectively. If you are intrigued so far and want more coverage on the dramatic twists and turns in the crypto realm, take a moment now to show some love and support. If you are even mildly entertained by the fact that the world's largest asset manager is swinging deeply into cryptocurrency, consider giving this content a like or a thumbs up. Your engagement keeps us motivated to dig deeper into the most surprising corners of finance. For those who have tuned in for a while, you know that the concept of a crypto ETF did not just materialize out of thin air. Various companies tried for years to get a spot Bitcoin ETF greenlit, only to be stymied by regulatory bodies that express skepticism over the potential for market manipulation, liquidity issues, and security concerns. The pivot that made IBIT possible is multifaceted. The national futures regulators in the United States created more defined frameworks for crypto futures. Certain governmental agencies softened their stance on digital assets, and major players like BlackRock discovered a new synergy with the emerging crypto economy. All of these factors slammed into each other like tectonic plates, forming brand new continents in the investment ecosystem. But the story does not end with mass adoption by advisors. Institutions, ranging from pension funds to large endowments, are quietly climbing aboard the IBIT train. For them, an ETF structured and managed by BlackRock offers clarity in terms of custody, regulation, and compliance. It is easier to integrate such a product into existing portfolio models that require stringent oversight. Many institutions already had a toe in the water via hedge funds or over-the-counter crypto vehicles, but have now found a simpler, more transparent way into the market. With compliance concerns alleviated by the fund's robust operational structure, decisions to include a slice of Bitcoin exposure become less daunting. Lest we assume everything is rosy and perfect, there are still genuine risks. Bitcoin's volatility is infamous. Overnight booms can be followed by equally startling busts. Additionally, there is the broader question of whether regulations may shift again, especially if political headwinds change direction. Some state lawmakers have shown hostility toward digital assets, while others champion the notion of the United States remaining a global leader in crypto innovation. Any major pivot in regulatory posture could either bolster or hamper the robust inflows that propelled IBIT. Moreover, there is the matter of technological anomalies, hacking concerns, and the overarching anxiety that the crypto market might occasionally run on hype. In other words, even though IBIT is wearing the metaphorical armor of a BlackRock product, it still invests in a notoriously mercurial asset. Yet the broader takeaway here is that BlackRock's ETF success is illuminating a shift so profound, some analysts are likening it to the changing of the guard in finance. In prior decades, major institutions typically took years to warm up to newfangled assets. Even exchange-traded funds themselves, when first introduced, were met with suspicion. Today, advisors and institutions are racing to add the digital asset possibility into their repertoire, often spurred on by consumer inquiries and the fear of missing out on potentially game-changing returns. we are also witnessing a revolution in how portfolios are designed. Traditionally, a 60-40 stock bond blend was considered a venerable fortress for moderate risk profiles. But now, some leading voices in the financial planning space, such as Rick Edelman of the Digital Assets Council of Financial Professionals, have championed the idea that even conservative portfolios might include a minimum of 10% in digital assets, while more aggressive portfolios could hold as much as 40%. When you consider that less than 7 years ago, many advisors balked at recommending even 1% in crypto, that is quite a reversal of perspective. For Edelman and those in his orbit, the success of IBIT underscores the notion that cryptocurrencies are not just a passing fad. They reflect a new category of investment that interacts with technology, global financial systems, and generational preferences all at once. Some younger investors naturally resonate with the autonomy and decentralization aspects of crypto. Older and more established investors, on the other hand, are starting to see how mainstream acceptance might lead to continued upside. Meanwhile, BlackRock's presence assures them that best practices in security and compliance are probably, and that word probably is key, being followed. One little known yet fascinating piece of the puzzle is how advisors are arming themselves with educational resources aimed at understanding everything from blockchain mechanics to tax implications. Surveys have shown that more retail clients come to their advisors brandishing articles or videos about cryptos and want immediate answers. That is the impetus behind this wave of financial professionals taking courses, attending conferences focused on digital assets, and forging alliances with crypto custodial platforms. The iShares Bitcoin ETF, by virtue of existing within BlackRock's well-established ecosystem, is a tangible anchor for these learning journeys. To get a sense of just how momentous this is, look at the numbers once more: $70 billion in under 1 year. That figure alone might have been unthinkable only a short time ago. Once the inflows roared in, the ETF soared unprecedentedly, halting only when the broader crypto market encountered a brief pullback in late spring. Even then, net investments of roughly $1,100 million poured in over one particular week, signaling that the slump was no reason for the big players to bail. Indeed, it was a sign of deeper confidence in the product's resilience. And if you are wondering about the future of this phenomenon, analysts like Eric Balchunas from Bloomberg Intelligence predict that advisors will keep piling in, possibly doubling their ownership stake in IBIT in the not-too-distant future. Meanwhile, other institutions that sat on the sidelines, waiting for proof that an ETF could handle rigorous oversight and glean long-term interest, might finally feel emboldened to follow suit. Suppose the wave of new entrants surges again. Could we see IBIT surge to $100 billion or more in assets under management within a second year? While it sounds extraordinary, it is not beyond the realm of possibility, given how swiftly it has climbed thus far. We have to remember there can be pitfalls. Suppose Bitcoin undergoes a particularly punishing drawdown. Could that spook new investors, leading to outflows? Absolutely, it could. But in the aftermath of multiple crypto winters, many of the largest players in the market have become increasingly adept at riding out the turbulence. Even a big correction might not quell the fundamental growth story behind regulated crypto products. In fact, corrections sometimes serve as stress tests, showing whether an ETF can maintain liquidity, whether daily market making remains stable, and whether compliance protocols are truly robust. If IBIT and other crypto ETFs can weather these storms gracefully, that in itself will be another reason for cautious investors to trust them. Still, skepticism persists in some corners. Hardcore crypto enthusiasts occasionally argue that an ETF, while convenient, dilutes the original vision of a decentralized finance system. They prefer direct on-chain ownership, which allows them to hold private keys and interact with decentralized platforms more directly. Meanwhile, crypto critics claim that even with an ETF veneer, Bitcoin remains a volatile and speculative choice that lacks the fundamentals to be considered a safe haven. In many ways, these polarizing viewpoints underscore how big a tent the cryptosphere has become. There is room for maximalists who want no intermediaries, and for mainstream investors who are happy to trust a globally recognized asset manager. So, will the iShares Bitcoin ETF continue its record-smashing journey for another year? Will we see a wave of imitators from rival asset managers? Major players like Fidelity and Vanguard typically pay close attention to new product categories, especially once they start attracting billions of US dollars in short order. And with ever more consumers interested in Bitcoin's role as an alternative store of value, it is likely that the big guns may consider ramping up their own crypto offerings. That might mean even more variety for investors, fueling competition that could tighten expense ratios, further adding impetus for advisors to allocate to crypto. If this exhilarating ride has piqued your curiosity, you can show your support by taking a quick moment right now to do something as simple as subscribing to our updates or hitting that follow button. Together, we can keep exploring these cutting-edge trends, from digital assets to the evolving financial frameworks that shape our daily lives. Every bit of engagement from you encourages us to continue providing deep dives into the twists and turns of modern finance. In tracking how this new era has come about, it is clear that IBIT sits at the intersection of regulatory clarity, brand strength, and shifting investor mindsets. It is a trifecta that is not easy to replicate. Smaller crypto-focused ETFs might dream of such lightning-fast success, but they must first surmount the brand credibility barrier. The Trump administration's relaxed crypto regulations laid an initial foundation, yes, but having the name recognition and institutional gravitas of Blackrock cemented the effect. Advisors, who require a certain measure of legitimacy to stand behind any recommendation, found that a well-known name was the missing puzzle piece that could let them cross the threshold. Though some might consider a $70 billion figure simply an indicator of froth or mania, others point out that it represents a fraction of the total assets that BlackRock manages. Indeed, the firm oversees trillions in total. Even a relatively small portion allocated to Bitcoin can appear gigantic in the context of standalone crypto products. The effect is reminiscent of a large cruise ship, shifting its course by just 1 degree, yet traversing an entirely new route across the ocean. The ripple effects are enormous because the vessel itself is so large. Now, imagine if that shift turned into a permanent heading, attracting more large-scale capital in its wake. Consider the vantage point of a typical financial advisor affiliated with a well-established wirehouse. Not long ago, it might have been unthinkable to propose a crypto allocation above, say, 2%, often couched in disclaimers. But now, with frameworks rapidly evolving, and with high-net-worth clients asking about potential hedges against inflation, or wanting to participate in digital revolution narratives, that same advisor might say, "We can dip our toes in the water with the iShares Bitcoin ETF, a product that has proven to handle billions upon billions in flows without imploding." This scenario was nearly unimaginable just a few years back. At the same time, the unstoppable forward momentum of crypto can also be seen in broader adoption across corporations, celebrities, and even philanthropic organizations. Notably, some philanthropic foundations have started accepting crypto donations, further normalizing the concept of digital asset ownership. With big-name celebrities and professional athletes taking paychecks partially in Bitcoin, the conversation about digital assets starts to permeate everyday life. Suddenly, your friend who invests in real estate might also hold a chunk of crypto in her portfolio, and your uncle who once swore off technology might be curious about diversifying with the help of advisors who champion IBIT. It's a cultural pivot as much as it is a financial one. As for the question of price speculation, that is the million-dollar query, or shall we say, the multi-thousand-dollar query. With so many factors converging, the unstoppable wave of brand-name ETFs, ongoing regulatory evolutions, and a different mindset among financial planners, some watchers anticipate a continued climb in the underlying price of Bitcoin. Others suspect that a correction is looming. In either event, the short-term gyrations might not hinder the unstoppable mainstreaming of crypto. The notion that an investor might incorporate a dash of digital assets in an otherwise conventional portfolio is quickly becoming accepted practice. If and when the market experiences the next inevitable correction, IBIT's real stress test will come into focus. Do massive outflows occur, or do we see advisors telling clients to hold on tight for the long haul? That answer could change the future of crypto investing for decades. Let us also consider the notion that crypto, for all its hype, still remains a fraction of global financial markets. Even Bitcoin's entire market cap lags behind giants in the equity space. But the ongoing institutionalization of digital assets, as evidenced by IBIT, might gradually chip away at that disparity. Over time, we can imagine a scenario where crypto is no longer a renegade alternative, but a standard piece of the global financial mosaic. Whether that is good or bad depends on one's perspective, but the direction appears clear. more regulation, more mainstream acceptance, and more integration into the standard suite of investment options. Looking ahead, it will be fascinating to see how new developments in blockchain technology, such as the rise of decentralized finance protocols, interact with products like IBIT. These protocols offer advanced functionalities, lending, borrowing, yield farming, but often with complexities that might alarm mainstream investors. An ETF that invests in broader swaths of the crypto ecosystem, from Bitcoin and Ethereum to select decentralized finance tokens, could easily become the next big thing. And as soon as a major player like Blackrock or Vanguard introduces it, we might see a fresh wave of capital rushing in. Of course, this entire conversation can be overshadowed by macroeconomic events. If inflation spikes or a recession hits, how strongly do digital assets behave as a hedge? The question used to make many investors squeamish, but now, with an instrument like IBIT standing front and center, real-world data is being generated at scale. As the months roll on, analysts can study how well the ETF performs during fluctuating periods of interest rates or equity volatility. The data gleaned from these cycles might inform a new generation of research and best practices around crypto investments, further legitimizing or challenging the asset class. Still, for the moment, let us take another step back and appreciate the improbability of what has transpired. A brand associated with the epitome of institutional finance embraces an asset that started with a ragtag group of cryptographers and libertarians. Then, within less than 1 year, that brand's newly minted crypto product swells to $70 billion in assets. Even the most jaded watchers cannot deny the magnitude of that feat. It signals that the lines between traditional finance and digital innovation have blurred to such an extent that we may never again treat them as separate realms. Now, as we arrive at the closing segment of this deep dive, let us reaffirm how critical it is to stay informed, especially if you are eyeing any slice of the crypto sphere. Learning about the underlying technology, analyzing the complexities of custody and key management, and understanding how an ETF might mitigate or sometimes amplify these risks remains essential. Education is the guardian of prudent investing. Keep your mind agile, remain curious, and be sure to consult with firms or experts who genuinely grasp the intricacies of both the regulatory and technical layers. Congratulations for sticking around to the end. If this journey fired up your imagination or answered some of your burning questions, consider sharing it with a friend or colleague who might be teetering on the edge of crypto skepticism. You never know. The next big wave of adoption might come from a conversation just like this one. Until next time, remember, what was once inconceivable in finance can become reality in the blink of an eye. The iShares Bitcoin ETF is living proof. $70 billion is a powerful statement, but it may only be the beginning of an unprecedented new chapter in how the world invests. Stay focused, stay informed, and stay curious. My friends, they are essential traits for navigating the breathtaking pace of financial innovation in the 21st century.